to understand the Chinese real estate problems today, we have to recognize that this is a manufacturer crisis.
This is what a Chinese real estate crisis looks like. Enough empty properties to house over 90 million people. That's more than the entire population of Germany.
There is a long-term structural problem in the Chinese economy which remains unresolved.
The housing crisis is so severe that it caused a rare event. Public protests on the streets of China. If you're wondering why this matters to you, Chinese real estate is the biggest asset class in the world, with a higher market capitalization than the US stock market and the power to move global markets. China is the world's largest consumer of commodities. This film will show you how its economy affects the price of copper, steel, and iron ore, and why housing might not be China's biggest financial concern. Back in 2008, China helped the world's markets recover from an American-made crisis.
In many ways, China is already in a recession.
But what could happen to the stock market if the next economic crisis is made in China? Here at Capital.com, we make all kinds of films, documentaries, and explainers. If you want to see our recent film on what could be the best month to invest, then click over here. But first, let's take a look at how China's economy affects the stock market. China is known as the factory of the world.
China now swings a very heavy economic stick indeed.
Which means if it sneezes, global markets might catch a cold. The blue on this map, which was produced by Visual Capitalist, shows that back in the 80s, the US was the world's foremost trading partner. But from the noughties through to the present day, more and more countries around the world decided to trade with China. But the Chinese economy isn't just built on exports. $49 trillion of equities were traded in China in 2021. So what went wrong? We're used to hearing about turbocharged Chinese growth, booming cities, and billionaires by the bucket load. But fast forward to 2022, and headlines are about falling markets and soaring youth unemployment in China.
Companies that are exposed to China obviously are struggling. The companies like Apple, for example, they sell a lot of stuff into basically China. Now, if you're talking about GM, okay, their biggest car market in the world is actually China, even basically bigger than the US.
And their problems began with this. It's not your traditional Hollywood villain, but housing has a track record of transforming global markets. It caused the Japanese slowdown of the 90s and sparked America's financial crash in 2008. And in 2021, real estate looked like it had the Chinese economy in its sights. Chinese growth over recent decades has been built on the back of Chinese buildings. Real estate accounts for 1/3 of China's economy, which makes its housing sector 20 times bigger than the UK's GDP. Since the 1980s, tens of millions of rural Chinese have moved to the country's rapidly expanding cities. Real estate companies met this record-breaking demand for housing by taking on record-breaking debt. And debt was where the problems really began, because it caught the attention of this man. In 2020, Chinese President Xi Jinping put in place a 3 red line policy for the property sector to stop irresponsible borrowing. It limited developers' ability to borrow depending on their ratio of debt against cash, equity, and assets, and many lost their business model overnight.
Almost 2 years of a harsh crackdown on excessive debt and excessive borrowing by real estate developers has created a situation where developers are unable to continue construction on homes that they've already sold to home buyers, but which have not actually been completed yet.
Real estate giants like Evergrande started defaulting on interest payments. Property buyers became protesters as they were left paying mortgages on unfinished buildings. And the price of Chinese property crashed by 40%.
This is a manufacturer crisis, brought about by Beijing in order to help essentially, I think, take out the weak guys, among the developers, because there are hundreds of developers in China, many of which are simply highly speculative, undercapitalized, are becoming increasingly a systemic threat.
The shockwaves quickly spread through the economy, putting asset managers, construction companies, and steel producers at risk. But this isn't quite the same as 2008. China can do things to its economy that America couldn't, which means the market might already have China's real estate problems priced in.
Unlike in the US, the Chinese government has a lot more control over the key stakeholders, whether it's state-owned banks or the property developers or bond investors, and they can use that leverage to force banks to extend refinancing.
The Chinese government stepped in with a stimulus package worth tens of billions of dollars, which boosted confidence in retail sales and industrial production.
And I would argue they haven't managed to control this crisis quite well up to now. Any other country, if you see a 40% drop in housing, there will be basically blood in the street. It hasn't happened in China.
But others fear the Chinese economy still lacks momentum and see a bigger problem on the horizon than real estate.
The only thing that makes me nervous right now is China's zero-tolerance policy.
COVID lockdowns in Western Europe might feel like a thing of the past. But China's zero COVID policy means a handful of cases can still shut down an entire town. 74 major cities that account for 35% of China's GDP have gone through full or partial lockdown since August, affecting more than 300 million people. The IMF has warned that zero COVID could shave a full percentage point off China's economic growth.
China finds itself sort of trapped in a ongoing sporadic lockdowns where it's difficult to see what the exit is, because if they were to switch to a different policy now, they would very likely see a huge wave of infections.
Lockdown residents have reported shortages of food and medical supplies. The fall in consumer spending alone could shrink the Chinese economy by 2% or $340 billion. That's more than the GDP of Singapore. If there is a slowdown in Chinese demand for goods and housing, that could have a big impact on one asset market in particular. China has almost 3,000 buildings over 150 meters tall. To build this high and this fast, you need lots and lots of commodities. China uses 52% of the world's copper, 56% of its steel, and 80% of its iron ore. But has a drought, a pandemic, and a real estate crisis slowed its consumption of commodities? In 2021, China's copper demand hit record highs, and that might be thanks to the green transition. Copper is a vital component in renewable technology, and China produces more wind and solar energy than anyone else, but that hasn't protected its price. Copper is a good indicator of the health of the global economy, and financial headwinds have caused its traded price to fall by around 17%. But has Chinese demand shifted the price of other industrial metals? To make steel, you need iron ore, and China imports enough iron ore to produce 10 times more steel than its nearest rival, India. That continued into 2021 as iron ore imports rose in line with the pandemic recovery. But as China's real estate sector started to cool, it began to wind back its production of steel, and their iron ore imports more than halved. Iron ore futures dropped 15% over the last 12 months, and the Van Eck ETF, which tracks the price of steel, fell over 7%.
There are, of course, commodity-dependent economies that continue to be very exposed to Chinese demand, and they will feel some pain from the slowdown. We're looking at countries like Australia, which is a major exporter of iron ore, Brazil, also a major iron ore exporter, used to make steel that is used in housing construction.
Iron ore is Australia's biggest export, and China is their biggest buyer, which means both mining companies and entire countries will be watching Chinese demand closely. When Vladimir Putin rolled his tanks into Ukraine, he transformed the political and the economic world order. Politicians and businesses had to re-examine who their friends were and who their foes were too.
One of the big impacts of the increasing risk awareness around the cross-straits issue, around the Taiwan conflict, is a reassessment of supply chains and an awareness that in some kind of Taiwan mainland military conflict scenario, supply chains around China and around Taiwan could be seriously disrupted. In the case of Taiwan, of course, it's advanced semiconductors.
But supply chain concerns didn't start with Russia's invasion of Ukraine. They began back in 2018 with this man.
China.
China's been ripping this country off for 25 years, for longer than that.
And those tensions could remain, regardless of the midterm elections or the next presidential race.
Trump declared trade war against China already back in 2018. So this is like the third year, okay, that China has been having to live with, an increasingly unfriendly the U.S. when it comes to its ability to export to the U.S. Obviously, I don't tell you, tariffs remains very, very high on a wide range of Chinese exports to the U.S.
A ratcheting up of Chinese-American tensions isn't a given. America may find itself more preoccupied with its own domestic divisions than China. But global markets might have to face a new reality and a future where Chinese economic growth isn't guaranteed. Thanks for watching. Remember, the price of stocks and shares may vary depending on changing market conditions. And don't forget to subscribe to stay alerted to our regular chart analysis videos each week and other explainers on big financial topics of the day.